We are not talking about expansionary fiscal policies, and this is demonstrated by some of the numbers that we see. So I asked the market participants to calm down.
Again, I would say this is the same kind of hysteria that we heard on April 2nd. There was a panic. And what I'm urging everyone here to do is sit back, take a deep breath, and let things play out.
The finance chiefs of two of the world's biggest economies asking markets to calm down, take a deep breath after a rout in Japanese bonds, and Trump's tussles with Europe over Greenland wrecked sentiment. And their message seems to be working for now. Live from Sydney, this is Insight with me, Paul Allen. Well, Citi is sounding the alarm. It says a sharp spike in Japanese bond volatility could ripple across global markets, hitting US treasuries and forcing investors to shrink portfolios. We assess that with our expert panel, Navin, Saigal, BlackRock's head of global fixed income for Asia Pacific, and Carol Lai, senior research analyst at Brandywine Global. Also ahead, AirAsia and AirAsia X to become one brand as Malaysia's capital A completes its consolidation after 6 years. Deputy CEO Farouk Kamal joins us for an exclusive interview on what's ahead for the airline. And as Indian equities fall to 3-month lows, we speak to one of the country's top asset managers. Edelweiss Mutual Fund MD and CEO Radhika Gupta will join us. That's coming up ahead. And of course, we'll have a lot more as well from Davos, conversations with the CEOs of UBS, DeepMind and Anthropic. Well, we've got Asian stocks retreating today, tracking losses in the US, investors grappling with rising trade tensions over Greenland and Tuesday's turmoil in the bond markets. We do see a few spots of green on the screen there, though. Chinese stocks in modestly positive territory, the CSI 300 better by 0.75%. And we've got yields backing off a little bit on the long end in Japan. We'll talk about that in a moment. In fact, let's do that right now. JGB's rebounding from yesterday's sell-off after Finance Minister Satsuki Katayama called for calm during an interview with our very own Haslinda Amin.
I don't have any concerns about the absorption of JGBs going forward because we have a well-thought-out plan for JGB issuances. I believe the Ministry of Finance of Japan is perhaps the best Ministry of Finance in the world in terms of our close communication and careful communications with the market participants.
Investors obviously disagree with the perception that you hold right now. They say that JGBs are not the ones to buy at this point in time. There are huge concerns about your finances. How do you respond to that when they say that perhaps Japan's bond market is a canary in a coal mine?
I think those concerns are misplaced. We put a lot of importance on sustainability of our public finance. If you look at the draft budget for all this year, for the first time in 28 years, we will be achieving a primary balance surplus. If you look at our economic policies, through our economic policies, the plan is to expand the size of the Japanese economy. We have already seen an increase of tax revenue by 84 trillion yen, and we are to spend without additional borrowings. And as if you could look at our dependency on JGBs, the public debt dependency is at a 30-year low. As the Minister of Finance, I am not going to ignore the concerns in the market. The Prime Minister has been talking for the past couple days about an election to ask for the confidence of the public. She has talked about a possible plan for reducing the consumption tax rate. I know that is one of the reasons why the market has become rather nervous. But she has said that Japan is not going to depend on issuance of deficit-covering bonds. Since October of last year, we have taken a very responsible approach to public finance, talking about responsible, sustainable, and proactive fiscal policies. We are not taking expansionary fiscal policies. And this is demonstrated by some of the numbers that we see. So I asked the market participants to calm down.
What concrete steps will you take to fund all the spending plans? There have already been massive, significant stimulus, and now the Prime Minister has said she's cutting the consumption tax, which amounts to 8%. That leaves a huge hole, I suppose, in revenue.
The Prime Minister is talking about reducing the consumption tax rate only for food items. Even with that, there will be quite an amount which will be required. But we have already reduced gasoline tax, and we have secured the financial resources every time we have decided on spending. We have explained it to the IMF as well. Just last week, I was in Washington, D.C. to attend the G7 and like-minded countries meeting, and we had a bilateral meeting with Managing Director Madame Georgieva of the IMF. And she knows that every time Japan takes an action, we have paid careful attention to fiscal sustainability, and we have been mindful of ensuring fiscal sustainability. We know that public debt dependency has been coming down, and she gives credit to that, and she fully appreciates that. This year, the fiscal deficit to the GDP of Japan will be the lowest among G7 countries, which is not widely known. And it is within this framework that the Prime Minister is talking about eliminating wasteful tax exemptions.
The market's obviously still not confident about Japan's finances. We're seeing 30-year JGB yields higher than the bunds of the same tenure. Might you want to stabilize the bond market somewhat? Might you ask the BOJ to increase its scheduled bond purchases Wednesday morning just to bring that stability to the market?
Of course, we will work to restore the market confidence, and we have already been in communications with institutional investors. We have already been in communications with the BOJ. I wouldn't be attending this Davos meeting if there were something that we could officially announce.
So you're willing to take concrete steps to bring stability to the Japanese bond market?
I've been in the position of Ministry of Finance for 4 months now, and it might not be as much as you imagine, but I have taken concrete measures to bring stability to the market. What I can say is that we have done so, and I will continue to do so.
Don't worry. How are you assessing the risk of contagion? We have seen treasuries getting impacted. We have seen the Australian bond market getting impacted. Might we see what's been deemed as the bond market meltdown in Japan impacting the rest of the world?
The recent JGB auction went very successfully, and we have a well-thought-out future option of the JGBs, and we are confident the future upcoming auctions will be successful as well. I don't think it's right for me to talk about the potential impact.
That's Japanese Finance Minister Satsuki Katayama speaking with Bloomberg's Haslinda Amin in Davos. Well, Citigroup's warning that a sharp rise in volatility in Japan's government bond market could spill over into other markets, forcing some investors to cut back risk across portfolios. In fact, US Treasury Secretary Scott Bessent said he had spoken with his Japanese counterpart as the JGB sell-off affected the Treasuries market as well. For more on the bond markets, let's get to Garfield Reynolds, who leads our Markets Live coverage in Asia. And Garfield, that was a question we heard Haslinda just put to Satsuki Katayama there as well. The risk of contagion, where are we at?
Well, there's a lot of recent memories of major contagion going in both directions. Last April, when the reciprocal tariffs set off extreme reactions in a range of markets, treasuries led the way in market turmoil then. But then later on last year, when we had some very bad JGB auctions at the long end, that set off similar meltdowns to what we saw yesterday in the Japanese bond market. And on those occasions, there was a read across for bunds and for gilts. We didn't really get a strong read over this time round. That is partly, I think, because it was very much a domestically driven sell-off, at least initially, with the concerns about the sales tax cut and the way that they're sort of playing whack-a-mole, and they've got the yen under control now. So concerns about fiscal profligacy in Japan are mostly being expressed through bond sell-offs like the one that we had yesterday. And yesterday's bond sell-off certainly got very extreme at the end. It seemed very much like a buyer's strike. There were even a couple of banks that were saying that was what they were seeing. So there are a lot of concerns on that day that just kept investors from touching them at all. However, with the big jump in yields and some of these reassurances overnight from the Japanese authorities, we are seeing a much calmer aura today. still leaves yields a lot higher than they were a couple of weeks ago.
Yeah, and to your point, I mean, to what degree is this idiosyncratic? Because we saw US 10-year yields rising as well. Is that more to do with the Greenland story?
No, I don't think the Greenland story had a huge impact on treasuries. It had some. There's definitely a tone of US assets underperforming at the beginning of this year, echoing what went on at the beginning of last year when we had some similar turmoil coming out of Washington. So treasuries maybe to some extent might be caught up in that. But, the moves in treasuries were more driven by those concerns about potential contagion from Japan, and Citigroup's comments about the potential for risk parity vehicles to offload treasuries amongst all this. That is obviously something that can weigh on the treasuries market, and there's likely to be plenty of nerves. Remember, too, the treasuries market has been roiled this year as well by the Fed's turn back towards a more hawkish stance. So there are not a lot of positive factors for treasuries in the short term.
All right. Garfield Reynolds there, who leads our Markets Live coverage here in Asia. Well, let's get more on the outlook for bonds with our guests. Carol Lai is Portfolio Manager and Senior Research Analyst at Brandywine Global. Also joining us, Navin Saigal, Head of Global Fixed Income for Asia Pacific at BlackRock. Thank you to you both for joining us. Navin, I'd like to start with you if I can. Satsuki Katayama calls for calm on the bond market, and hey, we get calm on the bond market. Maybe she should do this more often. But in your view, what really settled things down? It was more than just words, surely.
Hey, Paul. First of all, thank you for having me on the show. It's a great question. In my career, I found that the single best times to make an investment are when everyone else is selling and the market has dislocated, prices have dislocated from fundamentals or valuations. I think we got some shades of that yesterday in the Japanese bond market. Certainly, babies were thrown out with the bathwater in some other markets as well. And I think that is what investors are trying to contemplate with today as they sift through the market moves. And that, I think, itself is restoring some calm to the market. Just the sheer severity of the sell-off yesterday.
Carol, I'd like to get your view on that as well. Did you view a move like we saw yesterday as a buying opportunity, or are there still risks here? Is it catching the falling knife?
Hi, Paul. First, thank you for having me on the show. I agree with Navin. It's when you get such dislocations, that's when people are selling. It's almost like a capitulation, right? That's where you see value really coming out from the JGBs, and the fact that if you look at where Japan's structural growth is going forward, it may not actually call for such high super long end yields, right? So the super long end yields do seem like there is value there. I think where investors are trying to struggle with is how much volatility and how long they would have to hold these bonds. Or it could be that it could continue to sell off to some extent before some kind of pump comes back into the market. So as long as, the MOF is not signaling enough on, revising their budget deficit or not addressing the issue, inflation remains quite unanchored still, and the BOJ is not raising rates enough, you can expect some volatility in the JGB market.
Carol, volatility or the risk that we see selling resume at some point, because one of the factors that catalyzed this is an election promise to reduce sales tax to zero on food and non-alcoholic beverages in Japan, and that does blow a $32 billion hole in the budget. I mean, that's still there. Could we see more selling to come?
I mean, there could be, although I would say on the super long end, it is in a range that value has really come up. So there will be, investors who will come in to buy. But the problem is really, like I said, rates could continue to go up to some point until the MOF really comes in to say, that they're going to help the market, the domestic investors come back in. The issue here is that the lifers are still holding some of the underwater bonds, and they were obviously getting rid of them yesterday. And on top of that, you have now the regional banks and the stability authorities are starting to look at them as well. So there is a whole mix of picture of a demand and supply that is not coming back to equilibrium as of yet.
Navin, I'd like to get your view as well on that election promise. And I mean, we do have to remember that all sorts of things get said in the lead up to an election, particularly one where the incumbents try to secure a renewed and enlarged mandate. So with that in mind, how concerned are you about this pledge to reduce sales tax, the $32 billion hole that it opens up in the budget that I mentioned, and how that reflects on Japan's ability to pay its debts?
Look, Paul, it's certainly a risk, but at BlackRock, I think the right way for an investor to look at an asset, and the way we look at assets, is through pretty much the exact same lens. It's the lens of risk and return. I think the better question to be asking ourselves is, are we being compensated for the risks around a fiscal program that is as yet still has some uncertainty around it, an election that's a bit of uncertainty around it? And I think the answer is going towards yes, at 4% at the long end of the JGB curve, and if you look at the forwards, 5%, those bond yields do start to compensate an investor for some of the risks around the program. Now, I'd say that isn't still the best opportunity in the fixed income market today. The best opportunity in the fixed income market, where you are being compensated for a lot of risks, is actually in the front to belly of the curve. You can construct a global diversified portfolio of almost a 6% yield. I mentioned 4 and 5% in JGBs. You can get a 6% yield in a global diversified portfolio, interest rate plus some spread plus some FX hedge yield. That is the real opportunity. And I think the volatility at the long end, while it creates a lot of attention, demands a lot of attention, it does also take away attention from where the real return opportunity is for investors. And that's how we've positioned our portfolios.
Navin, if you're talking about a global balanced portfolio, does that suggest that you're not particularly worried about any contagion risk from what we've seen, the selling in Japanese debt?
I think those worries are always there, but if you're not that exposed to the long end, you can reduce the volatility that comes with long end interest rates while still harvesting a pretty decent yield. A 6% yield is pretty chunky, and if you can lock that in for 3 to 5 years, I mean, that's a really attractive proposition in an environment where many other assets are exhibiting much higher degree of volatility. It's almost like, if you're caught in a riptide, the right advice or the recommendation is not to swim against the tide. It's actually to go sideways. It's to swim in a completely different direction, get yourself out of the riptide. For the investment world, in investments, I'd say the equivalent of that is to be aware of what's happening in the long duration market, to buy when there is a dislocation in prices, but to keep the core of your portfolio in something that's really much more stable and differentiated. And that is the front to belly of the yield curve in a global diversified fashion that can get you up to a 6% yield. That's a very good carry.
Carol, I'd like to get your view also on the contagion risk idea, because it's not me saying it. I mean, we have a story from Citigroup on the Bloomberg terminal right now warning of the potential for triggering the sale of $130 billion worth of debt. Is this something that concerns you? We seem to have lost Carol's audio. We'll head back. We'll see if we can sort that out. Oh, okay. Carol's with us.
Yes.
Yeah.
So, sorry, Paul. So, as I was saying, at Brandywine, we are somewhat cautious about G10 rates at the moment. And why so? Because when we look at the world, the economy, from a very top-down view, we have had like 2 years of central bank rate cuts. You have had many governments putting in a stimulus, fiscal stimulus. The macro backdrop in itself is reflationary. And I think you see that, coming out in commodities and equity markets, cyclicals versus defensives, right? So we understand if we have that reflationary backdrop, rates would not do that well going forward, right? You don't want to be in that rates environment, except in certain pockets. For example, we do like UK gilts, we do like Australian bonds to some extent, where it offers us a certain amount of coupon, and we are seeing the macroeconomic environment change for them. So we do prefer those countries, but we want to stay out of most of the G10 countries as much as possible until we see some kind of feedback effect where there is some change in the macroeconomic environment. If not otherwise, there is some agreement that where JGB yields are, it is indicating that global yields actually should be higher given the kind of environment that we are in.
Carol, also about an hour ago on Bloomberg, we were talking to Jesper Cole of the Monex Group, and I think he gave us some useful context here. It's like, look, hey, step back. Compared to global peers, I mean, Japan's pretty much going back to normal, and the 10-year yield's probably below where it should be at the moment. Do you think that context is important, and do you think maybe we should be hearing a little bit more from the BOJ about this?
I think that context is very important. If you look at the entire JGB curve, I think the 10-year is the one that is still underpricing the BOJ rate hike, the potential BOJ rate hike, because they are getting back into a more normal kind of economic environment. And in that kind of environment, if you can tinker around with terminal rates and things like that, it still tells you that the 10-year yields on the JGB is actually still the one that is still, you can say that the yields are still too low, right? The super long end is where the value is. And so there is that flattener trade, right? But coming back to the heart of it, it's really where the BOJ has to come up stronger to, signal that they're going to raise rates and how fast it does, even tinkering with their terminal rate range, that would really help the whole BOJ, the whole JGB curve to anchor itself. Mm-hmm. And I think that's when, you start really getting people getting back into the market. But until then, I think there's still, people are still very uncertain.
All right, Carol Lai of Brandywine Global and Navin Saigal of BlackRock, thank you both for joining us today. Now, I just want to get you across some breaking news in South Korea. We are hearing from President Lee at the moment. He's making some remarks on the Kospi there, which, of course, has had a stellar run. It's up 15% just so far this year. He says he can't make a forecast on the Kospi index, but he says it is natural to see a divide in the stock market. He says Korean stocks are, in fact, undervalued. He also says political risk is contributing to the Korea discount, and he's vowing to crack down also on stock manipulation. Also, in terms of geopolitics, he's looking to sustain a good relationship with Japan and China. More ahead. This is Bloomberg. Welcome back. You're watching Insight. Here's a quick look at where things stand as mainland Chinese markets head to break and Japan comes back from lunch. We are tracking moves across JGBs today, recovering following yesterday's massive sell-off as Japan's Finance Minister Satsuki Katayama urges calm. Investors also weighing heightened risks in holding US assets and the dollar amid the escalating rift between President Trump and European nations over his pursuit of Greenland. UBS CEO Sergio Omotti telling us from Davos that this line of thinking poses even greater risk for investors.
Diversifying away from America is impossible. I think that in any major asset allocation, one could probably think about having an overweight or underweight, but diversifying away from the US and also from the dollar is a quite dangerous bet.
Well, joining us now is Anne Miletti, Head of Equity Investments at Allspring Global Investments. Anne, thanks so much for joining us today. And one of the themes of the past 24 to 48 hours has been a revival of the so-called Sell America trade. Are you selling America?
No, I'm not selling America. I still think it's a great place to invest, and the setup still looks pretty strong for 2026. We can talk more about that. But what I do believe is investors do have to diversify, and most investors have been under-allocated to the international and emerging markets for many years, and time is ripe to get there if you're not.
All right, so where would you diversify to? And does emerging markets, hold some appeal with a weaker US dollar, but against a volatile geopolitical backdrop, you've got to be conscious of a few risks as well, I'm sure.
You do. And I think, we were very positive on emerging markets as we headed into 2025. Our view was likely that the dollar was going to weaken based on where it was at the time. It's not necessarily our view as we head into 2026. We didn't anticipate the dollar to continue this weakening cycle. It could, but I don't think EM is totally dependent on it. What we're seeing now is actually a little bit stronger fundamentals across most emerging market countries. Again, not every, but several. And the trends are favorable. Again, whether it's, led by AI or consumption growth or just better fiscal responsibility in many of those emerging market countries, I think EM does look more attractive, especially when you look at the discount rates that they're trading at relative to the domestic markets. The spread is very, very wide. And with just 1 year of outperformance, I still think there's a lot of room for EM to run.
And right on cue, just as you were speaking, we saw the rupee crash through a record low, now 91.14 against the greenback. We have seen a lot of foreign funds recently going a bit cold on India. Where does that feature in your allocation?
I think our emerging market PMs are still relatively positive on India. Indonesia, those are two of their favorite places right now. Again, the setup is pretty strong when you look at demographics for India. And so while there will be fits and starts, there still are very attractive companies to invest in this space. So overall, we like India.
One of the things we haven't talked about really is this, I don't want to call it saber rattling, but let's call it trade threats and aggression from the US towards Europe over Greenland. The fact that you haven't really raised it, does that suggest that it's something you're not too worried about? Do you think maybe it's going to recede and we might be looking at a taco moment?
I think the frustrating part is having to talk about geopolitical risks, which are just kind of unfortunately commonplace across the markets and have been for the last couple of years. And tariffs are now a part of that as well. There's a lot of threats out there. There's a lot of tension out there. Again, what we've seen, certainly tariffs have been placed across many places, many economies, but they're not always as they appear at the surface level, right? So start off very, very high, end up not being quite as high as expected. So we'll see. We have a big speech coming up tomorrow, which could be a market mover. We'll see what happens there. But as we know, some of the talks start off as negotiation. And, we also have a court case that we're waiting on a ruling to see whether or not if tariffs are even considered legal. We do believe most of the tariffs will hold, that they will find other ways to hold them, but it will not be as easy. So again, it's more uncertainty for investors, which I think does lead to a reason why investors need to think about diversification.
Well, to your point on diversification in emerging markets, I'll give you Exhibit A, the Kospi, which has just been on a stellar run. South Korean stocks absolutely surging, even up 15% this year. Although yesterday we did see an unusual flash crash in a couple of the big names, which were Samsung, SK Hynix as well. They've since recovered from them. But when you look at a move like that, do you think maybe this market's getting a little bit frothy? How do you approach Korea at the moment?
I think what I see in several markets has been this focus on concentration, right, where there's just a few names that have really driven most of the gains in the market. And so what I want to see globally, and what I think will likely happen across the globe, is you'll see diversification around the number of names that can drive the market in 2026. And so again, we're seeing this in the US too, where the Meg 7 hasn't been those names haven't been the propeller of growth in the market returns in 2026. It's actually been the 493 that have mattered most. In fact, even the small cap, which is another area that we like, last week in a weaker market condition where the S&P was down for the week, the Russell 2000 index was actually up. So again, more diversification. I think investors need to look outside of those big large cap names that they've always gone to and look again for other companies that have good fundamental growth.
Yeah, well, let's talk a little bit about that because we are in the thick of earnings season in the US at the moment. What are you seeing in terms of companies that have, strong balance sheets and a good outlook? What do you like there at the moment?
I think, I was going to say when we started, it's kind of interesting because what was old is suddenly becoming cool again here. If you just look at performance over the last couple of months. So basic materials has been the best sector in terms of performance since November of 25, right? Kind of surprising to hear. But we also like manufacturing. So again, old school kind of economy sectors, we think have been ignored and maybe, have fallen behind in terms of where earnings could go versus their multiples and are now getting recognized by investors. So I think some of those older economy industries look more attractive. Healthcare, did see some outperformance in the second part of 2025. We think there's still more room to go there as well. But again, I would actually focus not just on what sectors, but individual names within every sector. This innovation cycle is real. We still like technology, but we would look beyond those Meg 7 names into broader areas of technology.
And before we let you go, I do want to get your view on what you think you're going to see from the Fed this year. We do have a meeting this month, no change expected, of course. But do you think there's a chance that expectations for easing could come down this year, just as they did in 2025?
Look, I think we still are in the camp where we think we're going to get a couple of more cuts, likely to be more second half loaded. But there's a lot of data. There's a lot of unknowns yet, so we'll have to see. I think, what we're more focused on is watching where growth goes to. And I do think between what we'll see with tax refunds and then some of the changes in the CapEx rule and the CapEx changes, you'll see some real growth potential coming out of the U.S. In the later half of 26. And so we'll see what happens with rates then. But we still kind of our base case is about 2 more cuts.
All right, good stuff. Thanks so much for joining us today, Anne. That is Anne Miletti, Head of Equity Investments at Allspring Global Investments. Coming up, China's Vice Premier presents his country as a model of cooperation and multilateralism. More on his Davos charm offensive next. This is Bloomberg. Welcome back. You're watching Insight. China is again portraying itself as an advocate of free trade as U.S. allies grapple with fresh tariff threats from the Trump administration. Vice Premier He Lifeng has been making that case in Davos.
Multilateralism is the right way to keep the international order stable and promote humanity's development and progress. The rules must apply equally to everyone. A handful of countries should not enjoy privileges based on their strengths, and the world must not return to the law of the jungle where the strong bully the weak. Every country is entitled to defend its legitimate rights and interests.
I just want to get you across some breaking news we're getting before we get to Steve there. We are hearing that Air Force One has turned around en route to Switzerland. This is according to reporting from Axios. The Post saying after takeoff, the Air Force One crew identified a minor electrical issue. Out of abundance of caution, Air Force One is returning to Joint Base Andrews. The President and the team will continue aboard a different aircraft to Switzerland. If there are any developments, we do have a little bit more development. Yes, he'll board another plane and continue on to Davos. We'll keep you abreast of anything more as we get it. Right, let's get back now to our Chief North Asia correspondent, Stephen Angle. So we heard those comments there from He Lifeng. Stephen, how are they resonating in Davos? It sounds like it might be a breath of fresh air.
Well, there's nothing new necessarily from He Lifeng, who is the economic czar, Xi Jinping's economic go-to guy, as well as vice premier and the top trade negotiator for those trade talks with the United States. So, we do listen to exactly what he is saying, but he's essentially trying to portray a sharply different view of global trade than what is being brought to Davos by the Donald Trump administration. He clearly sought to draw a sharp contrast to the U.S. He presented China as an advocate of cooperation, free trade, and multilateralism, as we just heard. But at the same time, he's also trying to court global business and global leaders to China's vision of being not only the factory of the world, but also the market of the world. And that dovetails with what China is trying to do. Its number one priority domestically this year in 2026 is to boost domestic consumption. And to do that, He Lifeng is arguing we are going to open up further to foreign products. The devil will be in the detail, and the proof is in the pudding, to use a couple of cliches, but it's pretty much in line with what they're trying to do versus some of the skepticism as well from global business leaders who are also in their home markets faced with a deluge of Chinese exports. Keep in mind, China had a $1.2 trillion US dollar trade surplus in 2025, a record. So that great rebalancing to stimulate domestic demand is a high priority. In fact, He Lifeng at Davos said, "We never seek a trade surplus. On top of being the world's factory, we hope to be the world's market too." So there's kind of two messages, Paul, that he sent to the crowd in Davos. We are champions of free trade, multilateralism, and we are open for business.
All right, Stephen Angle there, our China correspondent. Well, let's get to Hong Kong's financial secretary saying the city will need to issue bonds to finance a new development known as the Northern Metropolis, even as the budget returns to surplus. Speaking to us in Davos, Paul Chan also said he's optimistic about renewed IPO momentum in the city's stock market.
We are optimistic, very strong momentum. For example, in the pipeline, queuing up more than 300 companies wanted to be listed. We have taken a look of them, good quality, and also in AI, in health tech. So these are the sectors people want to invest in.
You talk about quality. There have been concerns about the quality of the IPO application process. I'm just wondering, how are you responding to that?
Well, perhaps the investment bank's business is just too good. So we have reminded them that in preparation of the documents submitting for approval in the IPO process, it would be better if they do more comprehensive due diligence, so that in fact, if they do their paperwork properly, they will save them time. Yeah.
Is there reason to tighten the application process? Would you consider imposing penalties for those who fall short from the standard and the quality?
Well, I think the professional sector, all the advisors and the investment bank included, they all want to be good, want to defend their reputation. So at this stage, I don't think we do not need to put in any punitive measures, but just to remind people, hey, do your homework properly, prepare the paper properly, then the IPO process can be faster.
So no reason to be concerned?
Well, at this stage, I think we perhaps better look at how to grow the market to improve further the liquidity and to support those companies, apart from IPO, the follow-on investments as well.
How are you addressing that? I mean, how are you hoping to grow the market? What are the measures in the pipeline?
Well, apart from mainland companies, we encourage companies from the other part of the world, Southeast Asia, Middle East, European companies, please do take advantage of our market to be listed in Hong Kong, tap the funds there, and use those funds to grow into the mainland and across Asia. Huge potential.
We know that there are rising geopolitical tensions around the world, especially in the West.
Yeah.
Might that work to Hong Kong's favor? Might you see more, foreign companies, Western companies coming to Hong Kong to IPO?
Well, people are looking safe havens to park their funds, and at the same time giving them good returns. They are looking for policy consistency and predictability. And in that sense, Hong Kong offers excellent alternative for them.
Of course, you're looking for fiscal surplus in 2026, quite ambitious, some say. But you remain confident. Why is that?
Well, 25-26, meaning year-end 31st March, operating account definitely a surplus. But our account composed of operating account and capital accounts. Land revenue still needs time to go back to previous level. But we do need to expedite the investment in Northern Metropolis. So overall speaking, we still need to issue some bonds to finance the investments in Northern Metropolis. But going forward, I'm pretty confident because on the operating account, we will still registering services with our fiscal consolidation policies. In the past 2 years, we control expenditure growth and grow a little bit of our revenue source. And for the Northern Metropolis, we are also experimenting different options. Say, for example, inviting investors or technology companies. They come, we just give them a parcel of land of huge size. They can do the infrastructure, they can bring the ecosystem over. And in that sense, expedite the development process. And on the other hand, cut down the government's commitment in terms of infrastructure provision.
You talk about plans for the Northern Metropolis, because that is a priority for China as well. I'm just wondering, is there reason to spend big on the Northern Metropolis when your financial conditions are still stretched at this stage?
We see this as investment. So we invest upfront to grow the ecosystem. When the companies come, they bring their ecosystem over. In future years, they will pay me tax. So we invest upfront and get the return in later years. In the meantime, the cash flow differences, we use bonds to finance a bit of it.
When it comes to those returns, realistically, when do you think those returns will come? And what kind of investments are you looking to put into the Northern Metropolis?
From a government perspective, the returns are multidimensional. Apart from financial return, they help us to transform our economic structure, to make our economic structure more resilient, create more quality jobs for our people, and also, technology and finance reinforcing each other. If we can make good use of our IFC status to grow the technology sector, that technology sector development will attract top talents, top companies to Hong Kong. That will help our IFC status as well.
I want to talk about the property sector, which is a key sector in Hong Kong.
Sure.
Despite removing capital, I suppose, measures in your budget for previous years, the increase in prices have not been sustained. Why is that so?
You mean the residential market?
That's right.
Well, actually, the residential property market in the past few months have been registering positive growth. At this level, stabilizing, going up slowly. And at the same time, when you look at the volume, huge. Over the past few months, since September, every month over 5,500. December, even over 5,900. So it's back to the normal level. With the improved confidence about the market direction, with reduced interest rates, and the result of our previous initiative in attracting talents and companies. I think the talents, the incoming companies will also provide support to the residential market. That tells you when you look at our residential market, the property price in the past few months, although earlier is downward adjustment, but rental went up. So the demand is there.
Might you have to implement more measures to provide greater support for the residential property market?
Well, in terms of mortgage provision, we have removed all the restrictions. It's back to normal. So let the market force come into play. And interestingly, in the residential market, students flocked into Hong Kong, also huge demand. We used to even encourage some of the office properties in suitable locations to be converted into student hostels. And in the next few years, we'll continue to attract students, not just from the mainland, but also from the other regions, to come to Hong Kong to study. This is important for us, not just as an education hub, but also talents for the future. We want them to stay and, to grow their family in Hong Kong.
That's Hong Kong Financial Secretary Paul Chan speaking with Bloomberg's Haslinda Amin in Davos. Let's take a look at how Asia benchmarks are tracking. It is a broadly risk-off day across most of the major markets today. We've got the Hang Seng Index, though, only off by about 1/10%. The Nikkei off by 2/3%. Even the Kospi, it's a stellar run so far this year, stalling out a little bit, down by 1/3% at the moment. But we do have markets in China modestly higher. If we take a look at what's happening in FX, it's pretty much a similar story. The yen still parked at 158, and we had the Indian rupee a short time ago sinking to a fresh record low below 91 versus the greenback. Elsewhere, the Korean won not really catching any tailwinds from the recent remarks from President Lee. Still pretty weak there, 1,469 against the dollar. I'll take a look at how precious metals are tracking, though, getting a bit of a tailwind from the so-called debasement trade. We've been hearing predictions for some time now about gold potentially cracking the $5,000 per ounce mark. Was getting pretty close, 4,843 right now. We've also got silver and platinum hovering around records as well. Still to come, AirAsia X Deputy Group CEO Farouk Kamal is going to join us to talk business strategy following their consolidation with the carrier's short-haul business. Also a closer look at Indian markets with Radhika Gupta of Edelweiss. More to come. Welcome back. You're watching Insights. Here's a look at where markets stand at the moment. It's very much a risk-off day. Even South Korea's Kospi taking a little break from the stellar gains we've seen, off 0.5%. In fact, very weak won has led to the suggestion that Korea's might need to delay that $20 billion investment package that it agreed with the US. As to whether or not there's any potential trade implications of that decision, we'll wait and see, right? We've got some very interesting moves on the currency front as well. The yen remaining very weak, but take a look at the Indian rupee, falling to a fresh record low now, 91.2425 against the greenback, but a lot of red across the board there. The Nikkei off by 2/3%. Although, on the subject of Japan, we have seen that chunky sell-off that we saw in Japanese bonds towards the end of yesterday abating. Well, speaking to Bloomberg in Davos, Japanese Finance Minister Satsuki Katayama did call for calm in the bond market during our interview with our very own Haslinda Amin.
I don't have any concerns about the absorption of JGBs going forward because we have a well-thought-out plan for JGB issuances. I believe the Ministry of Finance of Japan is perhaps the best Ministry of Finance in the world in terms of our close communication and careful communications with the market participants.
Investors obviously disagree with the perception that you hold right now. They say that JGBs are not the ones to buy at this point in time. There are huge concerns about your finances. How do you respond to that when they say that perhaps Japan's bond market is a canary in a coal mine?
I think those concerns are misplaced. We put a lot of importance on sustainability of our public finance. If you look at the draft budget for all this year, for the first time in 28 years, we will be achieving a primary balance surplus. If you look at our economic policies, through our economic policies, the plan is to expand the size of the Japanese economy. We have already seen an increase of tax revenue by 84 trillion yen, and we are to spend without additional borrowings. And as if you could look at our dependency on JGBs, the public debt dependency is at a 30-year low. As the Minister of Finance, I am not going to ignore the concerns in the market. The Prime Minister has been talking for the past couple days about an election to ask for the confidence of the public. She has talked about a possible plan for reducing the consumption tax rate. I know that is one of the reasons why the market has become rather nervous. But she has said that Japan is not going to depend on issuance of deficit-covering bonds. Since October of last year, we have taken a very responsible approach to public finance, talking about responsible, sustainable, and proactive fiscal policies. We are not taking expansionary fiscal policies. And this is demonstrated by some of the numbers that we see. So I ask the market participants to calm down.
What concrete steps will you take to fund all the spending plans? There have already been massive, significant stimulus, and now the Prime Minister has said she's cutting the consumption tax, which amounts to 8%. That leaves a huge hole, I suppose, in revenue.
The Prime Minister is talking about reducing the consumption tax rate only for food items. Even with that, there will be quite an amount which will be required. But we have already reduced gasoline tax, and we have secured the financial resources every time we have decided on spending. We have explained it to the IMF as well. Just last week, I was in Washington, D.C. to attend the G7 and like-minded countries meeting, and we had a bilateral meeting with Managing Director Madam Georgieva of the IMF. And she knows that every time Japan takes an action, we have paid careful attention to fiscal sustainability, and we have been mindful of ensuring fiscal sustainability. We know that public debt dependency has been coming down, and she gives credit to that, and she fully appreciates that. This year, the fiscal deficit to the GDP of Japan will be the lowest among G7 countries, which is not widely known. And it is within this framework that the Prime Minister is talking about eliminating wasteful tax exemptions.
The market's obviously still not confident about Japan's finances. We're seeing 30-year JGB yields higher than the bonds of the same tenure. Might you want to stabilize the bond market somewhat? Might you ask the BOJ to increase its scheduled bond purchases Wednesday morning just to bring that stability to the market?
Of course, we will work to restore the market confidence, and we have already been in communications with institutional investors. We have already been in communications with the BOJ. I wouldn't be attending this Davos meeting if there were something that we could officially announce.
So you're willing to take concrete steps to bring stability to the Japanese bond market?
I've been in the position of Ministry of Finance for 4 months now, and it might not be as much as you imagine, but I have taken concrete measures to bring stability to the market. What I can say is that we have done so, and I will continue to do so.
Don't worry. How are you assessing the risk of contagion? We have seen treasuries getting impacted. We have seen the Australian bond market getting impacted. Might we see what's been deemed as the bond market meltdown in Japan impacting the rest of the world?
The recent JGB auction went very successfully, and we have a well-thought-out future option of the JGBs, and we are confident the future upcoming auctions will be successful as well. I don't think it's right for me to talk about the potential impact.
That's Japanese Finance Minister Satsuki Katayama speaking with Bloomberg's Haslinda Amin in Davos. On the subject of Japanese bonds, we've got some breaking news for you. We've heard from Japan's second largest bank, Sumitomo Mitsui Financial Group, says it plans to increase its Japanese government bond portfolio to as much as double following that rout that we saw. And that does dovetail with what we heard from our guest last hour, Navin, Saigal, saying it might be a good opportunity to buy the dips. So Sumitomo Mitsui indicates indicating that it will be doing just that, also saying that it sees fair value for the 10-year at a range of 2.5% to 3%. Right now, the 10-year yield 2.298, so a little bit of room to run, or 2.304, I beg your pardon. So a little bit of room to run in terms of the expectation of Sumitomo. Now, a key trigger for yesterday's JGB slump was Prime Minister Sanae Takaichi's election pitch to temporarily cut food taxes. Bloomberg Opinion's Geroid Reddy says that while this is definitely a bad idea, it didn't merit the kind of reaction that it got from markets. And for more, he joins us now from Tokyo. Geroid, to your point, I mean, we got Sumitomo Mitsui viewing this as a buying opportunity. Was that an overreaction?
Absolutely, and I don't think it's the first that we've seen in the JGB market over the course of the past 2 years. You've seen a couple of these bumps. If I recall, there was one last May. There's been a couple along the course, and I think what we have to remember in this is that Japan is going through this process of normalization, essentially, of the bond market after years of yield curve control, after years of negative rates, zero interest rates. Now you're seeing a normalization, so it shouldn't be too much of a surprise that I think we see days like we saw yesterday, where people react negatively, the market reacts negatively to what certainly is, in my view, a bad idea, but as I say, not worthy of the kind of reaction that we saw.
Well, let's talk a little bit more about this bad idea, because, we saw your quote up on the board there saying that, look, this isn't a Liz Truss moment. We are heading into an election campaign. All sorts of promises get made, and it's not exactly the forum for nuanced policy debate. So are we opening a can of worms here with the consumption tax debate? I think you call it the Demon Gate.
Yeah, that refers to a quote that's going around about the consumption, that has gone around for many years, about the consumption tax. I personally am of the view that constantly debating the consumption tax and only the consumption tax is not a good thing for Japan. Japan needs more spending and it needs more tax revenue, and will continue to need both of those things going forward. Is the consumption tax the best tax in the world? No, it's not. We all know that it's regressive, but it is the tax that's on the books. To get to the level that it's at now took something along the line of 10 years for Japan, from going to discussing it to actually implementing it. It's not like it is in other countries where the consumption tax can be changed, on the day of the budget. There's a new tax rate implemented. If it could, then it would be different. The other thing about this temporary, cut that Takaichi is proposing is that temporary cuts have a habit of becoming very, very long-term cuts. Last year, Japan got rid of a provisional increase in gasoline tax that was implemented in the 1970s. It was on the books for over half a century, while still being called a provisional cut. So I have no faith this would end up being the temporary tax that it is being advertised as. And what I think Japan should do is come up with different ideas, better ideas for how to relieve the burden on low-income households that they are now seeing from inflation. But the thing that we have to remember in all of this is that, unlike a lot of other countries, Japan has wanted inflation for a long time. Japan is afraid of dampening things down too much and ending up with too little deflation, or ending up back in deflation. So that's where we should always remember that Japan is coming from.
All right, Bloomberg Opinion columnist Geroid Reddy there. Still to come this hour, AirAsia X Deputy Group CEO Farouk Kamal is going to share their business outlook following the consolidation with the carrier's short-haul business. This is Bloomberg. Welcome back. You're watching Insight. Malaysia's Capital A says it's completed the sale of its short-haul aviation business to AirAsia X. The move consolidates the group's airline businesses under a single entity to be named AirAsia, allowing Capital A to focus on its non-aviation units. Capital A is also seeking to lose the financially distressed classification that it received in Malaysia after the pandemic. AirAsia X has also appointed Bo Lingham as Group CEO after the restructuring, and he replaces the former CEO Benjamin Ismail, who was named General Manager. Well, joining us now exclusively is Farouk Kamal, Deputy Group CEO at AirAsia X. Farouk, thanks so much for your time today. And I just want to start on the completion of that acquisition of Capital A's aviation arm, the end of a 6-year journey there. So what's the plan for growth going forward?
Thanks for that, Paul. I think the strategy always remains the same. As an airline, our ambition is to connect ASEAN to the world and the world to ASEAN. So that will continue to be the focus. We will increase the frequencies and the network as we have it already in the APAC region, and we will also increase connectivity to the west. We have been flying to Tashkent, we've been flying to Istanbul, and we are also looking to set up a connectivity hub in the Kingdom of Bahrain, where we have further plans to expand into those regions, including Europe, including Middle East, including Central Asia region, and including Africa. So it's quite interesting times for the group.
Yeah, why the interest in Bahrain, and when do you think that hub's going to be up and running?
Well, I think when it comes to our strategy, we aim to be a narrow body focused fleet network, low cost carrier going forward into the future. With that, we do need a connecting hub somewhere in the Middle East. We have been talking to various parties in that area, in that region, and one of the destinations that was of interest to us in terms of the cooperation, in terms of the incentives, the work, the collaborative spirit happens to be the Kingdom of Bahrain. So we've only started discussion with them not so long ago, and a lot has already developed and progressed. So we look forward to start in earnest as soon as possible, as early as this year.
So talk to us about aircraft purchases as well. You do have that focus on narrow body going forwards. When do you think we're going to see that purchase of 150 planes that I think we've heard Tony Fernandez talk about in the past?
So I think you rightly pointed out, we are looking and exploring opportunity, expanding further the order book that we already have. But I think what we've always done well and good in the past is that we will only make a decision in terms of the order book that we purchase when it is a good deal, right? When it's a good deal for AirAsia. We've done that very well over the past years. We have already in existence a 370 order book delivering into the mid-2030s. And in addition to that, we are also exploring a regional type aircraft, as you pointed out, with various OEM manufacturers that has been in discussions with us. So yeah, I think the short of it is we want to do a deal as fast as we can, but more important than that is we will do a deal that works for us.
So in terms of aircraft delivery for 2026, are you able to say how many you expect to take delivery of?
Yeah, I think we have a few 331 LRs that we expect to deliver into 2026. I think we have 4 of them. So yeah, those that's part of the combination exercise initiative that we have. The LRs will serve a slightly longer flight route, and then that will also fit into the network expansion plans that we have.
So in terms of market expansion, what's looking more appealing to you at the moment? Is it short haul or is it long haul, and particularly if you consider the current tensions between Europe and the US?
Well, I think, the strategy again is connecting ASEAN to the world and the world to ASEAN. So it is always both, and it's always dynamic, and it's always changing day by day. As you are well aware, and as you've rightly pointed out, geopolitical issues plaguing the world also dynamically changes the strategy and the network and the connectivities that we have. So from a short haul perspective, the focus continues to be increasing the frequencies in the networks that we already operate in. That has always been something, again, that we continuously do, and we will dynamically ensure that works in line with the market demand. So the good thing about AirAsia is that we are an ASEAN core-focused network carrier, with APAC also as connecting into ASEAN. So we are able to redeploy the capacity in the network as the demands changes dynamically from time to time. From a long haul perspective, again, the aircraft deliveries that we have, the long range and the XLR, will then also feed into that strategy, again with the hub connectivity into Bahrain. Again, that's also important because those customers, those guests, feed into the network that we already have within the region.
In terms of the long-haul strategy, can you tell me a little bit more about that decision to focus on narrow-body aircrafts? Because of flights of over a certain duration, it's not tremendously comfortable. Is the focus more here on cost than comfort for your passengers?
Well, we always do it's both. We always, to the best of our ability, ensure that we achieve both for passengers. But, you're right. We always care about the costs. There is always a market out there for passengers who look to spend less in the air in order to spend more on the ground. That is what we focus on, and that is what we've been good at over the years. And we feel that this strategy, this narrow-body, medium long-haul strategy, will have a market for it, right? Like ASEAN families, 4 to 5 of them, you save 1,000 ringgit per passenger. That's already 5,000. You can use that for your experiences on the ground in the destinations that you go to.
Can you tell us a little bit about what you're expecting to see in the coming year for customer demand, spending power? Which markets do you see being the strongest, and which might lag a little bit?
Well, I think the demand is strong, and demand continues to be strong. But I think the network that we plan will be a function of the dynamically changing situation geopolitically, right? I won't name the countries, but even from the APAC region, you can see there is some issues there. So those kind of from there, people continuously need to travel. They will adjust their travel plans accordingly. We feel that as a result of that, ASEAN stands to benefit strongly from that, not just from an Asia perspective, but also from a European/US perspective. I think that is how we see the demand going forward here in 2026. Interestingly, also Malaysia is a Visit Malaysia year 2026. So we foresee a lot of strong travel into Malaysia for the year.
So now that you've completed the Capital A acquisition, what's that mean for rebranding? Are you going to be changing the name? You're dropping the X from AirAsia X. Does that mean repainting planes an additional cost?
No, not necessarily. I think when you look at it, right, you look at it from the perspective of airline operator, AOC, and then you look at it from a listed entity or from a branding perspective. With this combined entity, I think in order to ensure greater market clarity as to what we are, perhaps the AirAsia X listed entity name is no longer appropriate, right? Because the AirAsia X listed entity now has 7 AOCs across 5 countries under it. So we feel from a market understanding, market perception, market branding perspective, it may need a rebranding in that sense from a corporate perspective. But from an airline AOC perspective, it does not necessarily have to change.
And is anything going to have to change in terms of financial restructuring as well now that you've completed the acquisition? Will you be looking to tap capital markets for fresh financing? And we've reported before on this plan to put together a $600 million bond to replace some of your private credit facilities. Is that still the plan?
Yeah. So the good thing about being this combined entity is that we are no longer classified in the Malaysian context as a PN17 company. With that, domestic lending appetite has also increased, and we are working with domestic bank lenders to ensure that we refinance the borrowings that we already have in our books. That's number one. And number two, we are also looking at US dollar financing, as you highlighted. That enables us to collapse a lot of the existing tranches of financing that we already have into a single entity, and that ensures administrative ease for us. In addition, of course, to it being cheaper funding in nature. So ultimately, from a medium to long-term perspective, our goal is, of course, to eliminate the corporate debt borrowings that we have in our books. That has been something that that was the case, right, pre-COVID, and all our leverage will stay on the aircraft financing side.
All right, thank you so much. All right, Farouk Kamal, Deputy Group CEO at AirAsia X. Much appreciate your time today. Just want to bring you some live pictures of Air Force One landing at Joint Base Andrews, returning to base after an electrical issue described as minor. President Trump will switch planes and then resume his journey to Davos. Coming up, we'll get the Indian market outlook with Edelweiss Mutual Fund's Radhika Gupta. That conversation next. This is Bloomberg. Welcome back. You're watching Insight. The CEO of Indian textile giant Welspun says the company is navigating the impact of the Trump tariffs while talks on a potential trade deal drag on. Dipali Goenka spoke to us at Davos about trying to diversify away from the US, currently their biggest market.
Post-COVID, the world hasn't been the same. I think the important thing for us as Welspun is being agile, resilient, and I think that's going to be what it is. A lot of things are about, we're not going to lose a customer. We've been in this for the past over 2 decades. We have a leadership in the United States of America. We are going to work collaboratively with our customers to find solutions through. Because we are not just a vendor, but we're a partner. Diversifying the economies, and I think UK, Europe, rest of the world, and there are a lot of countries like Japan emerging. There are a lot of other things and opportunities there. India, again, is the 4th largest economy and coming up, and the GDP growth of 6.7%. I think that's where, again, there's a huge opportunity. And I feel in the tough times is where you start looking at different ideas. And, somebody really said, right, that trade is like water. It finds its way.
But the thing is, India faces 50% tariffs. Surely, at the end of the day, it does impact margins. It does impact sales. It does impact revenues.
Sure. You're absolutely right. It does impact everything. So there are a couple of things, let me tell you. When this hit us, we started working with one of the big fours to find solutions. And there are certain solutions that tends to mitigate a whole lot of it. And we are working with the customers to, see how we can, share that.
What kind of hit are you getting right now?
So we are definitely, if I look at my peers, their tariffs are relatively far more, lower than us. But sense of if I look at my reciprocal, it says 25 as a country, and the others are around 20 or 19. I can definitely see that through my solutions, through our solutions working with, our retailer partners and our big fours, we can find some solutions there. The rest 25 is not where, we're working with the partners or customers to take the impact. So definitely the impact is there, Haslinda. But if I look at a company and look at our balance sheets, we continue to look at our costs and literally with microscope. And literally somebody says that, our founder CEO is telescopic and also microscopic. And I think that's the lens that we've taken in costs, technology, AI, so that we can better our throughput. So we'll continue to work on that while our margins take hit here, but our balance sheets will still be strong. look at how we can really generate cash, which is like, sitting in the company to be ready for a war chest, so that we're pretty good there. So these challenges will persist, Haslinda, and I think opportunities to see how we can look at, partnering with certain countries to look at the supply chain, because it's
Which countries are you in conversations with?
So, we have a lot of brands, and we have partnered with ancillary, factories across the globe. For our brands, we can actually source from anywhere. And so that, again, is a huge opportunity. And
you earlier talked about diversification. The U.S. is 60% of market share. Yeah. How do you diversify? Are you actively trying to reduce that exposure?
You know what? We will continue to grow our diversification. This exposure
How does that
automatically
look like?
We already are at around 40 to 50% now with UK and Europe and the other parts of the world, like Japan and the other countries, India as well. So that will become 50% of what our top lines would be. So we will continue to grow that, while we'll continue to find solutions with the disruptions that are happening in America. And Haslinda, let me tell you one thing. We are into this for a long, long time. We know what home textiles is inside out. We are, we understand the supply chain. We understand the entire business in so deep that, we can literally work with ancillary vendors and partners to see how we can find solutions so that we can source out from different parts of the world. And we will also look at categories like pillows and bedding, which we are making and manufacturing in the United States of America as well.
How is the business at home looking? Because we've had, the consumption tax being removed. Is that translating to significant increase in business?
India, it will. It was announced in September. It's taken a couple of months to stabilize, but I know post-March it is definitely tending to go up, upswing. And I can also tell you the appetite for buying far more, kind of premium goods is what the Indian consumer is looking at. And I think that's where you see huge opportunities. In India, when you're talking about tourism, which is also growing, but the religious tourism is growing at a rate of 20%. That, again, is a huge opportunity. A lot of foreign chains of hospitality are coming into India as well. So that, again, is a huge opportunity. So, you will see a lot of opportunity, not in these terms of just consumers, but in commercial and institutions as well. And the same thing applies to Middle East as well. You see the GCC growing where it is. So there's, again, a huge opportunity to partner there. You're seeing Australia in a different light as well. That, again, is, so you're continuing to see those bright spots.
Can you share perhaps the kind of growth you're seeing in the respective markets, particularly in India?
So can I give you an analogy about India? India, the premium part of India is like London, which actually can spend more than $4,000. Then there's something like UK, which can spend like around a premium middle class, which spends around 2,500. And then you have Brazil, which is like your middle class, and then Africa, which is like continuing, which is kind of the bottom, but is a very important part of the population which continues to grow. So we are going to see a great opportunity here where, the opportunities in the terms of employment, opportunities in the terms of kind of the businesses that are coming in and, the choices of for people to, work is really growing.
That's Welspun CEO Dipali Goenka speaking with Bloomberg's Haslinda Amin in Davos. Well, the European Union says it's close to striking a free trade deal with India. Speaking in Davos, European Commission President Ursula von der Leyen called the agreement historic.
The next weekend, I will travel to India. There's still work to do, but we are on the cusp of a historic trade agreement. Indeed, some call it the mother of all deals. One that would create a market of 2 billion people, accounting for almost a quarter of global GDP.
Well, for more on the outlook for the EU trade deal with India, let's get to Bloomberg Economy, Trade and Investigating Agencies reporter Shruti Srivastava. So, Shruti, how significant is this deal?
Thanks for the question. So this deal is truly significant, as the European Commission President said, that this is, a historic agreement. Now let's first get the facts. This agreement has been in the making for almost 2 decades. The talks first started in 2007, but the talks were suspended in 2013 because of the gap in ambition the two sides had. They were resumed in 2022, and they gained urgency last year when the two sides announced that they are going to complete the negotiations by end of 2025. So this is truly historic in the sense that in Europe is one of the biggest markets for India. The bilateral trade between the two nations stood at 135 billion in 23-24. So it's the largest trading partner that India has. After US might be the biggest export destination, but in terms of a bloc, EU is a very significant market for Indian exporters. So in that sense, this is a big deal for both India and Europe. Both are right now navigating a very treacherous relationship with the US. For Prime Minister Narendra Modi, this is going to be a significant deal because it shows that India is trying to diversify its markets, and so that it can blunt the impact of high US tariffs on Indian goods. Similarly, EU is also navigating a very treacherous time with US President Donald Trump's ambition to take over Greenland, and it's escalating trade tensions with China. For Europe also, this is a very critical deal.
Yeah, does securing this deal take the pressure off to any degree when it comes to getting a deal with the US on a faster track? Because that really seems to have stalled at the moment.
So it's very difficult to say if this is going to, it's going to fast track India's negotiations with the US or not. But this is definitely going to help India, shield its economy from the tariff onslaughts, brought in by the US high tariffs. India is one of the last major economies which is yet to secure a trade deal with the US, and the tensions between the two nations, they still continue. The strain continues. So by securing this deal with EU, India is trying to diversify and not keep all its egg in the US basket. India is also in talks with countries like Chile, Peru. It signed 3 FTAs last year with the UK, Oman and New Zealand. All of these efforts are essentially to ensure that Indian exporters find newer markets, and they are able to blunt some of the losses that they are generating because of the high US tariffs.
All right, Bloomberg Economy, Trade and Investigating Agencies reporter Shruti Srivastava there. Let's take a look at how Indian assets are tracking. Meanwhile, we did mention a bit earlier that the rupee has now hit a fresh record low, pushing through that 91 barrier, and it's continuing to go lower still, now 91.34. If we take a look at how markets are tracking in India, very much like the rest of the region at the moment, modestly risk off, the Sensex off by 0.4%. Now, these two things are very much connected. We have seen foreign investors pulling $2.7 billion from Indian equities this month, and that comes on top of the $19 billion worth of outflows last year. A delay in finalising that trade deal with the United States, as we were just discussing there with Shruti, that's not really helping sentiment either. So a little bit of weakness in the Nifty, and it's being capped to some degree by foreign selling. Right, our next guest is a prominent figure in India's finance industry. Let's get market insights now from Radhika Gupta, MD and CEO of Edelweiss Mutual Fund. Radhika, thanks so much for joining us today. I think you mentioned a little bit earlier that 2026 is going to be defined by unknown unknowns and political shocks. Well, you certainly nailed the sentiment there. How should the average Indian be rebalancing their portfolios at the moment?
So I think the average Indian should prepare for volatility. I mean, I don't think 2025 was a particularly easy year or a very good year from an India point of view. I mean, a combination of a lack of trade deal and earnings slowdown was not a very good year. But I think in 2025, the inputs for a better 2026 were laid by the government in terms of all the work on direct taxes, indirect taxes, lower rates. So I do believe that 2026 2026 will be a better year than 2025. But that said, when you have trade deals that are ambiguous, random conversations of Greenland that happen overnight, I think the Indian investor should be preparing for incredible amounts of unknowns and absolutely middle path investing. So for instance, we've seen broader markets in India meaningfully correct in January. So a much more flexi cap oriented multi-asset kind of approach is perhaps where the Indian investor should land this year.
Well, we might have a known coming up pretty soon. India's budget will be released in February. Do you think the capital segments are going to be coming under pressure, or might that give you a little bit of tailwind or certainty at the very least for Indian equities?
I think the budget is honestly becoming a smaller and smaller market event because you don't need the budget to be the only factor that is deciding policy or major reform or major action. I think in NDA 3.0, the government is very clear with what they want to do. So capital expenditure is not rising in a major way, but it's not being stopped. So I think capex is going to continue to be what it is, the key theme is building and driving consumption. Now, last year, the budget gave a large personal tax exemption. Perhaps the market will be a little happy if there are some more tax reliefs for the middle class. But I think the key core theme has to be driving growth. It's also a tricky year because of all the benefits in direct and indirect taxes. The government has a treacherous balance on managing fiscal numbers this year because there is some loss on tax revenue. So it's a little bit of a tricky year. I'm not sure how much they can do, but I think this is the direction, and I don't foresee it as a very major market event.
You don't think it's going to improve the appeal of state-owned companies at all?
Every year in January before the budget, there's a conversation on state-owned companies' appeal increasing. There's a conversation on excise, but I don't think that's going to change.
We've seen a lot of foreign outflows recently, as I was mentioning just before we began our conversation. Do you feel that is, first off, rational, and do you anticipate it continuing in 2026?
It's actually not foreign outflows for a couple of months. It's been foreign outflows for a few years now. I think India has not had a period of both domestic and foreign inflows coming together, despite the success in the stock market since COVID. I think it's largely been driven by domestic flows. Whether it's rational or not, I think global investors have a context now. Rates have come off in global markets structurally. So I think in the long term that should help. I think India valuations have meaningfully corrected from where they were 2 years ago, even in broader markets. So I think these two things continue, should be a helper. And I think India's growth thesis remains intact. So if a global investor is looking at India, I think stability and growth remain intact. In fact, drivers for growth are perhaps better, and earnings growth should be better. So I think foreign inflows, we might be nearing the worst of FII outflows. Now, whether they're going to come back in 3 months, 6 months, or 1 year is truly anyone's guess. January is clearly a risk-off month, so I don't see this reverting, in the immediate future.
How do you feel earnings season has been so far in India? The initial sense seems to be we might have a disappointing season. Where are you on that in that regard?
It's frankly too early to say. We've got a couple of IT results which have been okay. I think, capital markets results, we've seen some of the larger capital market players, including asset manager, declare very strong results. Banking, we think is coming to a bottom. So I think Indian financials as a segment, both lenders and capital markets players should start to do better. And I think, banking results have been also mid. I do think that when the consumer, companies companies start declaring results, because festive season was good in India and we had the benefit of indirect taxes, you should start to see some positive bump up, but it's early days. I can say quarter two was expected to be a very damp quarter, and that was not as bad. So we actually think quarter two might have been the bottom of results. A better quarter three was also factored into market growth last year.
You previously said that you don't think large caps might be driving the next rally. So where do you think the best risk-adjusted returns are for 2026?
If you were to ask me, actually, it's the mid-cap index. Now, I think, it sounds like an unconventional opinion, but if you look at how India classifies mid-caps, it's a little bit of a different from the rest of the world. In India, we have a rank-oriented, not market cap-oriented definition for mid-cap. So mid-cap in India is 100 to 250th company by rank. And if you look at the earnings trajectory, earnings disappointment and earnings acceleration, actually the best risk reward has been in mid-caps. The mid-cap index is also not the cheapest one, but on a growth-adjusted basis, I think mid-cap is the sweet spot of companies that have got business model and governance right, but also have headroom to grow. And if you look at things from a sectoral thesis point of view, many of the sectors that we continue to be very excited about. So, for instance, healthcare and hospitals, capital markets, which I've spoken about a little bit, tourism and hotels, a lot of them are very well represented in the mid-cap index.
We've seen quite a lot of retail interest recently in ETFs, commodity ETFs in particular. Do you think this is a sustainable trend for your fund?
No, we run meaningful gold and silver ETFs, precious metal ETFs, and precious metal ETFs in India have seen their assets meaningfully grow. I think almost tripled in the last 1 year. Is it sustainable? So I think Indians have historically had a love for physical bullion that's moving to financial bullion. I would say part of it is sustainable, part of it is froth. There's always some element of it that is anchored to 1 year return. So when you see gold up, 40, 50%, when you see silver prices 150% in 1 year, there is some recency impact, I'm not going to lie. But I think people are structurally realizing in India that in addition to domestic equities and fixed income, commodities and to some extent international assets have to be part of their asset allocation. So it also represents a little bit of maturing of the Indian investor.
Now you've got new products as well, SIF, specialized investments funds, gaining a bit of traction with retail investors as well. But can you tell us a bit more about that and how well understood it is by retail investors?
So it's a new category. It's coming at an appropriate time. I would compare specialized investment funds, which the regulator has opened in India, to public market or liquid alternatives in global countries. And, you see in the US, for instance, that category has grown meaningfully. And of course, in India, the regulator has let us do much less than we are allowed to do in global market. But it's the first time asset managers in India can have net negative exposure on the market. So previously you were not allowed to hold outright short positions. Any short positions were only for the purposes of hedging. I think if markets continue to remain volatile and you see more muted market returns, the category is certainly going to take off. The Indian investor fundamentally likes risk-adjusted returns, and this category is shifting the conversation to that. We've certainly seen, much faster than expected growth even in our first launch.
Radhika, before we let you go, I would like to get your views on the rupee as well. It's just keeps setting fresh record lows today, now 91.38. Where do you see the currency heading, and how great a risk would you characterize this to markets?
So I think if you look at the Indian rupee, it's depreciated at about 3.5–4% a year. And I usually say this, though people don't like hearing it as much in local markets, I don't see that trajectory is going to change. And I think Indian exporters have, of course, been hurt over the last year. I mean, I talked to a lot of people in the export business who've been hurt with all the tariffs. So in some sense, a depreciating rupee, while we don't like it, is also a little bit of respite to them. And perhaps it's why RBI hasn't stepped in as aggressively as it has. So I don't see the 3.5-4% trajectory meaningfully changing. The fact is, though, it's not 3.5-4% on a steady year-on-year basis. The last couple of months has been exceptionally sharp.
All right, Radhika Gupta, MD and CEO of Edelweiss Mutual Fund. Thanks so much for joining us today. We have plenty more ahead. This is Bloomberg.